Hello everyone, welcome to my channel Sujit Patra, Ekdam Real Estate. So in the present times, we have observed that the interest rate has gone up. In most of the countries, the central bank has increased the interest rate also. Similarly, our central bank, that is Reserve Bank of India, they have also increased their repo rate. So this increase of repo rate has affected to the commercial banks and all the NBFC and housing finance companies, and ultimately down the line also it has affected the borrower also. So this pinching of increase of EMI has affected to all the borrowers due to the increase of repo rate, because our RBI has increased the repo rate since May 2020. Since May 2020, our RBI has increased the repo rate many times. So this increase of repo rate has affected to the all the borrowers, whether it is home loan or auto loan or it is personal loan or commercial loans. Whoever borrows the funds, they have been affected. So it is a very challenging times how to manage this increasing rate, how to manage the EMI our as a outgoes. It is a very challenging time because our income is fixed, but the outgoes of increase of EMI is not compensated with our increase of income. So it is a very challenging time how to control, how to manage this home loan interest rate, and how to repay the EMI regularly with a smile. So that is a very challenging and difficult times. So but we have to manage with a smile. So how to manage this home loan interest rate high with a smile, that we have to ponder upon it, that we will discuss now in the current video. So this RBI, why they are increasing this repo rate? So the RBI has got monetary policy. This monetary policy is RBI has got many instruments under monetary policy to control the inflation and deflation. Whenever there is in they want to control the money supply or inflation, they have got lot of instrument. This RBI monetary policy is chaired by the Reserve Bank governors. So they have got many instruments to control the money supply and to control the inflation. The primary is the repo rate. So the repo rate is the what RBI lends to the commercial banks. So that means if the RBI increase the repo rate, so it will affect the commercial banks or the finance sector also. That means the banks ultimately they have to increase the lending rate to the customers or to the borrowers. The other instrument is the statutory liquidity ratio. So this also falls under the monetary policy, and this affect the money supply also, because this statutory liquidity ratio is the minimum deposits banks kept with themselves. So this is the minimum deposit. So they have to deposit within themselves in the form of cash, in the form of liquidity. So and if the RBI increases the liquidity ratio, it is called SLR. If RBI increases the SLR, the banks they have to increase the SLR. So ultimately it will affect the money supply with the banks, and it will affect the credit system also. The other is the bank rate. The bank rate is the RBI lends to banks without security. So that means the bank rate is slightly higher than the repo rate, but when RBI increases the bank rate, so it will affect the money supply, and the ultimately the borrowers will be affected. The other instrument is the marginal standing funding. So what is that marginal standing funding? So the RBI lends to banks in a overnight. Suppose the banks they have liquidity, or the interbank system they have the liquidity crunch. So immediately the RBI will rope in and RBI lends to the banks overnight and by taking securities. So that will also affect the money supply as well as the inflations. But this is the banks takes from the RBI under an emergency scenario. If the internal banking systems having no liquidity, then the banks, commercial banks, they avail it from the RBI. The other is the open market operations. Open market operation is the RBI sell and purchase government security and treasury bills. This government securities and treasury bills generally secured by the high net worth individuals, big corporates, and the commercial banks. When RBI purchases the uh, government securities and treasury bills, so it will also squeeze the funds in the market, and when the RBI sell it, the government security and treasury bills, and it is purchased by the uh, corporates and banks, so it brings the liquidity in the system in the market. The other instrument is the cash reserve ratio. So it is a reserve ratio the commercial banks has to keep with RBI. So if the RBI increases the cash reserve ratio, so that also squeeze the liquidity ratio and the money supply, and generally RBI adopts during the inflation times. The other is the reverse repo rate. Reverse repo rate is the opposite of the repo rate. That means the RBI borrows from the banks. This also to control the inflation. So when RBI borrows from the banks, so ultimately the banks also they will get interest, but it will also squeeze the market. So these are the instruments by which the RBI controls the inflation and the money supply in the market. If you see the reported history since May 2020, the RBI has continuously increasing the repo rate. In October 2020, the repo rate was 4%. Again, it has increased to May 2022 to 4.4% to 4.9%, 5.4%, 5.9%, 6.25 in the month of December 22. Then recently in the month of February 2023, it has increased to 6.5. So it is an increasing trend by the RBI to control inflation and the money supply. But this increase of repo rate, it is definitely affecting the home loan borrowers. It is increasing their EMI also. So this movement also of interest rate by different financial institutions by banks. So every financial institutions also they are passing the increasing interest rate to the customers also. Ultimately the customers is they are getting affected. The HDFC also they have increased their interest rate from 8.6 to 9% after the repo rate increase. Similarly the SBI also they have increased their MCLR from 8.5 to 8.6, and ICICI Bank also they have increased their MCLR from 8.4 to 8.65. Similarly, Bajaj Finance also they have increased their interest rate from 8.6 to 9%. Tata Capital also they have increased their interest rate from 8.7 to 8.95. But in all the financial institutions, there is a range looking into the different categories of the customers, their CIBIL scores. So it depends. But average rate which we have presented here is that it is an increasing trend of interest rate by almost all the banks and by all the financial institutions, and it has affected the home loans borrower also. This increase of interest rate has resulted in increase of EMI. Suppose if you take the example of if a person has availed a loan of 30 lakhs for 10 years with a rate of interest of 8.4%, the EMI was 37035, and after the increase of interest rate to 8.65, the EMI has increased to 37437. So there is a increase of 402 rupees. Similarly, for a loan of 50 lakhs with tenure of 20 years and the rate of interest, prevailing interest rate was 8.7, the EMI, current EMI was 44026, and the interest rate has gone up to 8.95. So the EMI has increased to 44826. So there is a difference of 800. Similarly, for a loan of 75 lakhs or term 20 years, and interest rate increased from 8.6 to 9%. Similarly, the EMI has also increased from 60898 to 62940. So the banks also, they are passing the interest burden to the customers, and their home loan borrowers also, they are feeling the pinch of increase of EMI. So how to manage this increase interest rate or increase EMI? There are many options which we'll go on discussing now one by one. The major options available to the home loan borrowers is the repayment of loans. You can start repaying the home loans partly. If you have got surplus cash, you can repay the home loans partly, because nowadays most of the banks and housing finance companies, they are not charging any prepayment charges. So you can start in prepaying the loans partly. By prepaying the loans, you can reduce your loan tenure. If you reduce your loan tenure, then definitely your interest burden will be less. Or else the other option is that you can reduce your EMI part also. If you reduce your EMI, but obviously your interest burden will remain the same. So this is the major options available to the borrower to pay partly loans. The other option is that shifting of home loans to another bank and another housing finance companies or NBFCs. That means home loan balance transfers. Because there are certain scenario. Suppose your existing banks, they refuse to reduce the interest rate. So the option available to you to switch over the loans to other banks. By switching over to other banks, you will get a lower interest rate. Now suppose if you are feeling your interest rate is high, you can shift to the banks to lower interest rate whoever is charging. But before shifting to the another banks, you have to see their terms and conditions, what are the interest rate, what are the processing fees, what are the administrative fees, what are the other charges, and what are the documentation charges. These all the factors only you have to see before switching the home loans. Other this cost benefit analysis you have to consider before taking any decision of home loan transfers. The other thing is that suppose you are trying for more home loan tenure with your existing financial institution or banks. Suppose if you are to increase your loan period from 15 years to 20 years, but it will tantamount to restructuring of loan, and this restructuring of loan will reflect in your CIBIL scores, CIBIL report. So definitely, if it is appearing as a restructuring loans, it will affect your credit score and it will affect your credit rating in future also. In order to avoid that, if you want to increase your loan term, so it is a better option to go for balance transfer to other banks. And another major wise decision, suppose if you have availed home loans where your credit profile was not so good, or there was some delinquency in your credit profile, for that only you have been charging higher rate of interest. If you are now, suppose you have paid some 2-3 years and your credit profile has been improved, so it is always better to go for a balance transfer with other home loans lenders, so that you will get the benefit of lower interest rate. There are certain home loans providers are there who are providing this overdraft facilities, because this overdraft facility is a facility given to the borrowers. Like there are many financial institutions like Axis Bank, SBI, ICICI, IDFC First Bank, and Bajaj Finance, Aditya Birla Finance. They are giving all this overdraft home loan facility. So by this you can open a current account or a saving account, and you can get this extra liquidity. You can get this facility of extra liquidity. And suppose if you have got some surplus fund, you can put in that overdraft facility. And what the home loan provider will do, they will take that surplus amount into your outstanding home loan. So ultimately you will get lesser interest rate by availing this overdraft facility. So it is always better to have this overdraft facility when in the looking into this present scenario of increased interest rate. The other option is that increase your EMI. Suppose if your financial goals are satisfied and there is no immediate financial goals to, or there is no financial requirement immediately, you can go for increase of EMI. Suppose you have availed a home loan of 50 lakhs with a rate of interest of 8.5 and term is 20 years, and EMI comes to 43991. So how much interest you are paying for this 20 years? You are paying 54.14 lakhs. That is the interest is you are paying for a period of 20 years. And when the home loan interest rate is hiked to 8.75 and you are keeping your EMI as constant, so the loan tenure will increase to 21 years, and obviously your interest amount or the interest payable will also increase to 59.53 lakhs. So that means there is an additional interest burden of 5.39 lakhs by increase of interest rate from 8.5% to 8.75. So how to counter this increase interest rate? You can increase the EMI. Suppose your original EMI was 43391. Now suppose you increase this to 44186. So but there is a extra payment per month, that is 795 rupees every month you are paying extra. But by this you are getting interest benefit of 3.49 lakhs by paying interest of 56.04 lakhs. So by paying an extra EMI of 795 rupees per month, you are getting interest benefit of 3.49 lakhs in a period of 20 years. So this is one option to reduce your interest burden. But in general, if you see the, suppose if you have availed a home loan of 25 years and by hiking your EMI by 10% every year, your loan will end in 10 years and 2 months. By hiking loan by hiking your EMI by 5% every year, your loans will end in 13 years and 3 months. Similarly, by paying extra EMI every year, your loan will liquidated in 19 years. That means your 25-year loan you can repay. So this is the thumb rule. Suppose if you pay 10% extra every year, then your loan will be converted from 25 years to 10 years. So similarly, if you pay 5% extra, your loan will be converted from 25 years to 13 years, 3 months. And if you pay one EMI extra every year, your loan will be converted from 25 years to 19 years. And if you pay continuously pay the same EMI, your EMI will repay in 25 years only. So these are the options available to manage our increased interest rate, to cope up with our increased EMI also. So these are the major options available to the home loans borrowers. Those they can exercise the options. Hope you have liked my video and you have enjoyed my video also. If you have liked my video, please like and share my video, as well as please consider for subscribe my channel also. Thank you.